In this question, it told that Pesa Ltd commenced manufacturing on 1st January 2014 after incurring the following capital expenditure. You're given all those details there and additional information, and you're required to determine the capital allowances due to Pesa Ltd for the year ended 31st December 2014. So as usual, the ranking of the computation is that we start by looking at the investment deduction, then the industrial building deduction, then finally the wear and tear allowance. So let's look at our investment deduction. Remember, this is given for productive capacity, manufacturing and the like. So what do we have? Let's see. Factory buildings, yes, but that has been qualified by a note 1. We are told that factory buildings includes a dwelling house, a commercial building, a shop, and a showroom. So those are not part of the factory buildings. We need to eliminate them. So factory building, the initial amount was 8 million, so we now less. We have the dwelling house, we have the commercial building, we have the shop, we have the showroom. Showroom was how much? 600,000. So when I deduct that, I get that my factory is at a net of 3220. In addition to that, what do we have? We have processing machinery is also part of manufacturing capability, 2.4 million. So it is at 2.4 million. However, there was a note that I had seen relating to that processing machinery. So let's just look at it. Number 2, processing machinery excludes interest on loan of 240. So now this amount needs to be capitalized. Okay, so just add 240 that, and installation costs amounting to 60,000. This again should be capitalized. So 240 plus 60. Gives you 2.7 million. What else is part of productive capacity? Let's go back to the main working. So saloon car, no. Neon, no. Computers, no. Delivery van, no. None. Water tank, no. Water pump, 40,000 would be. Software, no. Lorry, no. We've already dealt with that and that and that. Staff canteen is industrial building. Quarters, industrial building. So there's nothing else. So let's add up what we have. This gives you 5960. So investment deduction is at 100% of 5960. We can now move to the second part, which is on industrial building. Allowance or deduction. So let's see what buildings we have. Ignore that. Ignore. Wait a minute. There's a water tank of 90,000, which should be part of the building. Ignore. Go to the notes. Note 1, factory buildings includes a dwelling house of 1180, which is not part of that, and a commercial building comprising an office of 1.2. So this one is industrial building. Commercial building comprising an office of 1.2 million. Shop of 1.8. And a showroom of 600. Let's read through the other notes. We have already done with note number 2. Note 3 is about a car. Note number 4 is industrial building. We are told that there is a staff canteen of 840,000. The key thing you have to watch out for is this date, 1st September 2014. So the canteen is for 4 months. The cost is 840,000. Then we go to number 5. The quarters of the workers have been renovated, 1.5 million. The other part is 1 million. So coming to a cumulative of 2.5 million. When did they start using these ones? On 1st October 2014. So that means that we are dealing with 3 months. Now, for any part that is considered to be commercial building, we use 25%. So 25% will apply for the office, for the shop, and for the showroom. All others will be at 10%. So the industrial building deduction will be for the water tank, 90,000 times 10%, which gives you 9,000. For the office will be 1.2 times 25%, which gives you 300,000. For the shop will be 1.8 times 25%, which gives you 450,000. For the showroom will be 600,000 times 25%, which gives you 150,000. For the staff canteen will be 840,000 times 10% times 4/12, which gives you 28,000. For the workers' quarters, it will be 2.5 million times 10% times 3/12, which gives you 62,500. Now when I add all of these up, what do I get? 999,500. We move on to the last one, which is on wear and tear allowances. Class 2, Class 3, Class 4, 37.5, 30, 25, 12.5. Our opening balance was nil because we started operations this year. We now look at additions. So go through the notes and see the additions that we have. Don't do that. Don't do that. Saloon car, 2.8 million. Remember, saloon car is restricted to 2 million. Saloon car is class 3. 2 million only will be taken. Neon advertising sign is a class 4. Computers are class 2. Delivery van is class 3. Furniture and fittings is class 4. Ignore water tank. Ignore water pump. Computer software will compute that separately. Look at lorries first. 3 tons. These are heavy lorries, so it will be under class 1. So note 1, factory buildings, you've already considered that. Machinery, you've considered that. Saloon car was disposed, so that affects us. So disposal. So the saloon car, we have to use the 2 million over the cost that was restricted. So we know that the saloon car had a cost of 2.8. So 2 million over 2.8 M times the disposal proceeds that we have, 1.8 million in note 3. Which gives you 1285,714. Let's now compute the wear and tear allowances based on these numbers. Remember we had said that for computer software we'll work it out separately, 1.2 million. So yes, computer software does not fall into the other categories, so we just compute it separately here. At 20% of cost, the cost of the computer software is 1.2. And with that we come to the end of that